Be Wealthy and Smart, episode 503.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about one of my most popular episodes that happens all year. It's called 10 Financial Moves to Make for 2019. And I've done this the last couple of years. It turns out to be one of my most downloaded podcasts, although my best of all time had to do with the lottery. Go figure on that one. Why your lottery winnings aren't really as much as you think they're going to be, or something close to that was my all-time popular, most downloaded show. But this one comes pretty close. And I think it's because people are in that mindset of New Year's resolutions. They want to make some changes. They want to do some positive things. They want to do things differently than they did last year so that they have a better year, can make more money, can keep more money, can build more wealth. And I'm here to help you do all of those things. So I'm going to give you a little bit of wealth mentoring today as your wealth mentor. And we're going to review some of those things that are really practical that you can do. And again, with everything I try to show you, they're things that make a huge difference. I did a couple of shows on how to save tens of thousands of dollars. I'm actually going to continue that series in the future. I have lots more ideas and more shows to do under that heading. But I did 2 shows about how to save tens of thousands of dollars because I think in the financial world, we can get very focused on, having an app that moves pennies from our account into another savings account. And I'm not saying that's bad. That's, great to want to save money and make an extra effort to save some extra cents. But we do that, and then we miss the huge things, those things that are literally costing us tens of thousands of dollars, such as I've talked about so many times before, like moving too frequently and what it costs to really move and how it literally does cost tens of thousands of dollars out of your pocket every time you buy and sell a home. So I'm going to focus with you today on the things that are going to make a big difference in your bank account. I'm not going to tell you to do the app to invest the cents, okay? You can figure that one out. But what I'm going to tell you are the big things, the things that will really move the needle, that will really help your net worth, that will really get you on the path to making a big dent in 2019. Because I know that's what you really want. I know you want to make a huge difference in 2019, and I'm here to help you make it. So without further ado, we'll get started on our list. The first thing I want you to do is review your asset allocation. Now, this is super important because one of the things that I'm seeing that's very common right now is for people to have all of their money that's in the stock market invested in the S&P 500. They're just taking 100% and plopping it into the S&P 500. That's not a good way to invest, all right? You're missing out on a lot of opportunity. And if you've been following some of the performance updates that I do pretty much quarterly with the show, you'll see that a lot of the performance has actually been coming from the smaller companies. Those small companies are not the S&P 500. The S&P is the opposite of that. They're the largest 500 companies in the US. So by not investing in the small companies, you've missed out on some spectacular performance during the year that smaller companies have been enjoying. And that means that you're not compounding your money as fast as you could be. It's always all about compounding. That's what wealth building really is. It's about the compounding. So we want to make sure we can compound at the highest rate. And to do that, you're going to need to diversify your portfolio and not have everything just in the S&P 500. I want you to look at the asset allocation model that your brokerage firm provides for you or your employer provides for your retirement plan, because both of those places are going to have asset allocation models for you. Now, asset allocation is basically a combination of your age, your risk tolerance, but people tend to be a little bit too conservative when they're young. And that is one of the things we've talked about in the past, is that if you're too conservative when you're young, you're going to have too much of your portfolio in lower compounding type investments like bonds, and not enough in the higher compounding type investments like equities, stocks. So we want to make sure that we're matching your age and your asset allocation model. Nobody feels comfortable saying that they're an aggressive investor when they're just starting out. All right. Everyone feels like, oh no, I'm a conservative investor. But a conservative investment portfolio is going to get you a whole bunch of bonds and not much in stock. All right. That's the problem. And so you do need to think about how much time you have to invest, because if you have 20 years, 30 years, 40 years until retirement, you definitely need to be in the aggressive bucket. You need to be in that because you're going to have a higher percentage in stocks. Now, as you're getting closer to retirement, if you're 7 years away from retirement or less, you want to start changing your asset allocation so that you do have less in stocks and less at risk, but you are changing that allocation so you're lowering the risk that you have, lowering the percentage that you have in the stock market. And that's how you're going to allocate your funds differently as you get closer to retirement. I'm not a fan of those target date funds, and I think you know what I'm talking about. And the reason is because they have a lot higher fees and they have a much higher percentage of bonds than I think most people should have, because a lot of the track records are based on past performance and not looking forward. They're looking in the rearview mirror where interest rates were declining, and that makes bond valuations go up. But now that we're in a rising interest rate environment, that makes bond valuations go down. So why would you want to put more of your portfolio in the part of it that's going to be going down as interest rates go up? So bonds do provide some extra income, and that does provide a little bit of a cushion to a portfolio, but rates are so low, they really don't provide much of a cushion these days. So just be aware that you can handle your own asset allocation. You don't need to put it into a target date fund to do it for you. You're paying a lot extra for that, and you really don't need it. It's really a marketing ploy. So review your asset allocation, see if you need to rebalance, if you've gotten heavy in one area or another, and your allocation has gotten too heavy in the small company stocks, for example, you might want to sell off some of those and buy the larger company stocks to get it back into the original allocation percentages. So think about perhaps rebalancing back to your original asset allocation models if certain categories have grown too big and gotten much larger than they were originally. That's called rebalancing. All right, once you've reviewed your asset allocation, the second thing I want you to do is contribute more to your 401k or 403b. Now, this is one of the best things you can do for wealth building. A lot of people do actually accumulate $1 million in their retirement plans. I've done podcasts about that and how to do that, and you might want to go back and listen to that. But you need to max out your 401k if you can. And that's because you're going to get free money from your employer if they match. Even if they don't match, your plan will grow without tax, and it will come out without tax if you have a Roth version. If you have a regular 401k, then you're putting in pre-tax dollars and you'll pay tax later on. But the limits went up this year in 2019, so you can contribute $500 more than last year. So you need to adjust your contribution limits. For 2019, you can contribute $19,000, or if you're over age 50, you can contribute $25,000. In an IRA, they also raised the limits $500, and you can contribute $6,000, or if you're over age 50, then $7,000. Your deductibility is going to phase out on a Roth depending on how much money you make. So try to estimate what you think your annual earnings are going to be and then determine which IRA would be the better choice for you. A Roth if you can, but if you make too much money, then a traditional IRA. All right, once you've reviewed your asset allocation, contributed more to your 401k or 403b, the third thing to do is to reduce your high interest debt. Now, hopefully you don't have any debt, but if you haven't been focused on reducing your debt, use my debt diamond approach. I did a podcast on that, which is reducing your high interest rate debt first, but also reducing your debt where you've utilized more of your credit. Because if you reduce the high interest rate debt, that's going to save you money. And if you reduce the credit that is most utilized, for example, if 80% of your credit is utilized on one card and only 20% is utilized on another card, you want to start paying down that 80% card, because that's going to start improving your credit score as you're paying down the debt. So unless that 20% card is much higher interest, it is better to start paying down that 80%, the higher utilization, to get your credit moving in the right direction. So use my debt diamond method. And I also am not a fan of prepaying your mortgage off unless you're paying a little bit extra each year to whittle it down over time. But I'm not a fan of paying off your mortgage 100% unless you're a very wealthy person and you have a lot of extra money laying around. But if you're not a super wealthy person, if you're not a multimillionaire, then you want to not pay off your mortgage, because it's more important to get your money into an investment account where it can compound higher for you and create wealth for you than it is to pay off 3% debt or 4% debt on your mortgage. It just doesn't make financial sense to do that. I know people talk about peace of mind and how they are going to feel so much better when they pay off their house. I get that. And if you're super risk averse, okay, maybe that's something for you. But we're talking about how to get you to become a millionaire or financially independent or financially free. And believe it or not, the way to do that is not to pay off 3% money on your mortgage or 4% money on your mortgage. The way to do that is to take that money that you would have paid off your mortgage with, get it invested, get it compounding at a higher rate, and that's how you're going to build additional wealth. Paying off 3 or 4% money is just not a good use of your financial resources and can really set you back in your wealth building. I do, however, like people to pay an extra $100 a month on their mortgage or 1/12 extra per year. So if you're paying, for example, $2,400 a month on your mortgage, pay 1/12 of that, which would be $200 a month extra. So pay $2,600 instead of $2,400 a month, and that will still cut about 7 or 8 years off of your mortgage, so it's paid off early, but you're not really going to miss that extra couple of $100 that you're paying off on your mortgage. So you have the best of both worlds. You're paying it off sooner, and that will make you feel better, but you are not putting all of your resources toward a 3 or 4% debt. Financial move number 4 is to dollar cost average more money into the stock market. So we've had lots of volatility with the market, and one of the ways that you can really take advantage of that is by dollar cost averaging. That's by investing the same amount in your investment account each month. So on the same day of the month, your broker will automatically take money out of your account and buy whatever stocks, mutual funds, ETFs that you've selected. Let's say you're taking $500 a month and putting it into your brokerage account. Then on the 10th of the month, it goes into the stock market. And every month on the 10th, it goes and buys shares. That essentially is taking emotion out of investing. And that is being able to buy the dips without being emotional. Whether the stock market's going up or down, you're buying on the 10th of the month, each month. And so as the market goes down, it's a good thing because you're buying more shares. As the market goes up, you're buying fewer shares, but of course, all of those shares that you bought lower are now going to be nicely appreciating. So if you have a long-term time horizon, it's a great thing to be able to dollar cost average into the market. Again, this would be something that would be a lower priority on your list than putting your money toward your 401k, because your 401k has other tax advantages and might have matching free money from your employer. So you want to do your 401k first. Number 5, be sure not to get too overweight in real estate. A lot of times when we're getting late in a cycle, people start to jump in. I've heard people say they want to start doing flips now and they want to start buying real estate now. Well, we're really late in the cycle. And I've been doing podcasts about how housing prices have actually been coming down in major cities, how high-end real estate has actually been crashing. And so this is not something that you want to be jumping in full bore right now if you're late to the game. So just be aware that this cycle has gone on about 18 years, which is about the regular cycle for real estate. We're starting to see interest rates go up, which generally will drive down prices of real estate, make homes stay on the market longer. New construction has slowed. There's a lot of very obvious signs that the market is slowing. Now, having said that, that doesn't mean I'm negative on real estate at all. I think real estate is a great investment and it's an income-producing investment. That's fabulous. I'm just saying we may not have the capital appreciation in the price of homes that we've had at the same rate we've had for the last 18 years. And it might take longer to sell a home than it has. You might not be getting the multiple offers like it was when the market was very hot. Things are slowing. So just be aware and don't be all gung-ho to suddenly get started with your real estate portfolio when we are relatively late in the cycle. So just be cautious with that. Just follow the trends, be aware of what's going on in the market, understand that things do move in cycles. Interest rates affect real estate very dramatically. And should we continue to see rising rates, which we know that the Fed has talked about raising interest rates another 0.5% next year, it looks like that will probably continue to keep real estate prices in check. Now, having said that, lots of markets are different. Some are better than others, but even the hot markets like Seattle, San Francisco, New York, we've seen slow down. So just be really cautious. Make sure that you're giving yourself lots of wiggle room in your numbers when you're looking to buy something. Make sure that it cash flows quite nicely and don't buy anything with negative cash flow in this kind of an environment. Number 6, think over any large purchases that you want to make. Again, this is where you can spend a lot of money and lose a lot of money. If you're buying new cars every 3 years, that can be a huge source of losing money for you. You want to buy something a few years old in great condition that will last a long time. And I've done podcasts about cars that will last for 200,000 miles or longer. You want to take a look at those. If you drive a lot of miles, those are the kind of cars you want to own. So don't be buying new cars all the time. Don't be buying a new car off the lot. It's going to depreciate. You're going to lose that value. And that's money that you could have invested and done something with that is actually going to cost you a lot of money. You can lose 20, 30% of the value of a car in just a couple years, and that doesn't make it a very good investment at all. So you want to stay away from new cars, let someone else take that depreciation hit, buy it a couple years old, and keep it for as long as you can. You also want to not move very often. As I said earlier, moving expenses, getting a new loan, paying points on the loan, paying real estate commissions, paying moving costs, paying remodeling costs, paying for repairs. These are things that cost you when you sell and they cost you when you buy, and they can add up to lots of extra money. So try not to move very often. Try to stay put in your house as long as you can. Another thing to be aware of are very expensive electronics. Some people have more invested in their cell phone than they have in their bank account. So be aware that some of these electronics are very expensive. Ask yourself, do you really need these things? And try not to go overboard having the latest gadget all the time. Ladies, sometimes we're a little bit more guilty of going overboard in the designer clothing area with handbags, shoes, high-ticket items. Just be aware that these things are costly to you in terms of opportunity cost. Every $10,000 you spend on these items costs you about $174,000 over 30 years. You want to be very aware of where you're spending those tens of thousands of dollars. I want to pause for a moment and tell you this episode is brought to you by Audible. It's a way I can read more books and stay ahead of the curve. There's no way I could read every book that I want to read if it weren't for Audible. All I have to do is listen, like you are right now. There are over 150,000 titles to choose from for your iPhone, Android, Kindle, or MP3 player, and your first audiobook is free. Pick out which book you want. I suggest Think and Grow Rich. Just visit audibletrial.com/be wealthy and smart. So audibletrial.com/be wealthy and smart. Sign up today. You can quit at any time, no obligation, but anywhere you are, in the car, while you're walking, just like listening to podcasts, you can be learning and listening to books and increasing your knowledge. And finally, don't buy a lot of what I call the toys, which would be the RVs, the motorcycles, the three-wheelers, boats, things that cost a lot to insure, maintain, pay for gas, where you have to store it. These are things that can cost a lot of money. And again, opportunity cost is tremendous on these items. That plus the depreciation that you're incurring on any of those is going to put a huge dent into your wealth building. So just be really aware that these things are going to cost you money because you could be investing that money somewhere else. Rather than having to own the vehicle or the toy, is there some other way that you can participate and rent it for a period of time rather than having to own it and pay for all of the expenses that go along with that? Number 7, make sure to update your will and your beneficiaries. So your will can be affected if you had a major life event like a wedding or a new baby, or if there was a death or an illness in the family. These are reasons why you probably want to review your will and see a good lawyer. And you also want to update your beneficiaries on your retirement plans and on your insurance policies. Remember that your beneficiaries that are listed on your retirement plans and your insurance policies are going to take precedence over who is listed in the will. So if you got divorced, which is another major life event I should have mentioned, you want to make sure to take your ex-spouse off of your life insurance policy and off of your retirement accounts, because even if you get remarried, those beneficiary designations are going to go to the person listed as the beneficiary and not who's listed in the will. So you don't want your ex-spouse, I wouldn't think, to get your life insurance benefit, your retirement benefit, etc. So make sure to update your wills and beneficiaries, especially if you've had big life events. Number 8, consider starting a side hustle. I was just reading an article that said Social Security will run out of money in 2035. I don't know if there's something we can do by then or what the plans are, but this I do know. You want to take that income generation into your own hands. You don't want to rely on somebody else to give you money. You want to either buy a property that's going to be income generating or have a side hustle, a business, an internet business. You want to do what you can to generate extra income on the side. I think thinking about that years in advance of your retirement is a really good thing to do. And I would encourage you to start researching and participating and starting a side hustle. Number 9, look into what new cycles might be forming and what new compounded annual growth rates are out there that might be pretty high in some exciting investment areas. I've talked about some on the show, like cannabis stocks that I'm very excited about. I've also talked about artificial intelligence, infrastructure, because I think there is going to be a lot of infrastructure that money will be spent on bridges and roads and highways and airports, and all kinds of infrastructure spending is going to take place in the next few years, as well as more defense spending. So I would look in that area as well. I also did a podcast a while ago on what I like instead of the FANG stocks. I think the FANGs will continue to have issues. Some of those issues are in regards to privacy, such as Facebook is having because it has been selling people's private information. So I think there are going to be some issues with some of the FANGs, and I would encourage you to look at some smaller companies that are up and coming, that are the future FANGs, if you will. And again, I did a podcast about that a while ago. There are some really exciting companies that are younger, growing fast, and really interesting to look at. Also, it's going to be interesting to see in 2019, we have two big IPOs coming up for Uber and Lyft. And I'm not recommending that you invest in those. And it may be difficult anyway to get shares in an initial public offering. That's when the company goes from a private status to a public status, and they offer their shares, rather than being privately held, they offer their shares to the public. And they raise capital that way. So you can become a shareholder after they go public, and you may want to look at, do you want to buy one or both of those companies? Would they be good long-term investments? Do a little research on them. I know that Uber is much bigger than Lyft, but Lyft is growing about 3 times as fast as Uber. So these are different things to consider, and there are pros and cons to each company. Something interesting to think about. And finally, my 10th idea for you is to keep following the 6 steps to wealth. If you've been following this podcast for any length of time, you know what the 6 steps to wealth are. Briefly, I'll restate them. Number 1 is to create a wealthy mindset. Step 2 is to save a nest egg. Step 3 is to find a mentor, which is what you've done here. Got that one checked off. Step 4 is to invest in a money engine. Step 5 is to compound at a high rate, and step 6 is to protect your wealth. So you want to continue to work on all of these. Work on your mindset, work on saving money that you can invest, work on investing better and generating higher compounding rates, and then not getting too over leveraged, not getting too concentrated in any cycle that is getting too long. That's how you protect your wealth. So keep following those 6 steps to wealth. Keep putting those into practice. There's tons of podcasts about all of those, and you can go back and review any of those particular areas that you think you need more help with. There are lots and lots of podcasts to help you do that. So I would just review those. Most of the podcasts that I do are evergreen. I really try to make them evergreen so that they don't ever get dated. Of course, the performance type podcasts where I'm talking about how stocks have done year to date are going to get dated, but other podcasts are generally evergreen. So it means that even if I talked about it 2 years ago, it's still timely and it's still classic. And the concepts that I recommend don't change. So you might want to go back and review some of those earlier podcasts. And I know on iTunes, you can't get all of my podcasts anymore because they only give you the latest 300. And since we're on number 500, you can't access the first 200. But you can on my website at lindapjones.com/podcasts, plural, PODCASTS. I have all of my podcasts there, and so you can listen to any of them, and you can see all 500 of them on my website there. And if you haven't yet checked out my book, You're Already a Wealth Heiress, Now Think and Act Like One, 6 Practical Steps to Make It a Reality Now, I think this would also be a good step for you to take. This is not just a book for women. The men are loving it too. The principles that I put in there, the Millionaire Action Plan, they're gender neutral. It doesn't matter whether you're a man or a woman. These are principles that apply to both. So check out my book. It is sold out on Amazon right now, but as I understand it, it should be coming back in mid-January. And if you order now, you'll be at the front of the list and you'll make sure to get a new copy. If you haven't yet checked out my Instagram page, we're having a lot of fun over there talking about wealth concepts. It's at instagram.com/Linda P. Jones. And thank you to everybody who has left reviews and subscribed to the podcast. I'm so grateful for the reviews you've left. The things you write are just amazing. It really, really touches my heart. It really makes me just, I don't know, you just have no idea really what it does when I read your great reviews. I just feel very grateful for you and so thankful for you. So there you have the 10 financial moves to make for 2019. I hope that you put these into practice. I hope that I've got you to think about things a little bit differently, maybe make some different plans at what you were going to do. Just to review them again really quickly, first you want to review your asset allocation, consider whether you should rebalance, diversify, things like that. The second thing is to contribute more to your 401k or 403b. The limit has increased $500 this year on those and also on IRAs, so contribute more. Number 3 is reduce your high interest rate debt. Use my debt diamond formula to do that. Number 4, dollar cost average more into the market. Number 5, don't get too overweight in real estate. Number 6, think over your large purchases, especially cars and toys with wheels and boats, designer clothes, electronics, and moving too often. Number 7, update your wills and beneficiaries on your retirement plans and insurance policies. Number 8, consider starting a side hustle for extra income. Number 9, look into new cycles that are going to provide high compounding growth rates. And number 10, keep following the steps to wealth. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.